Good, good,
All right.
yeah, probably not to talk.
All right. So welcome once again. We want to take capital reduction, reconstruction. Now, this is where a company is making persistent losses and that the managers of the organization are deciding, or the owners of the organization are deciding to either shut down, that is called liquidate, or reorganize their capital structure. By so doing, it is the policy that you check the two schemes and advise management which one you think would be more appropriate. Is it the reconstruction that is appropriate, or is it the um, liquidation that is more appropriate? So when we finish, you should be able to advise management whether to liquidate or to continue. So it says that a capital reconstruction scheme is a scheme whereby a company reorganizes its capital structure after persistent losses has resulted into income surplus deficits and liquidity problems. A reconstruction scheme might be agreed upon when a company is in danger of being put into liquidation but holds up good promise of profits in the future. So the company would like to reorganize their capital when they realize that the projections they are putting in would end up giving them profit. If it doesn't give them profit, and at the end of the day when they are liquidating, would rather save them. You tell them. So, to liquidate means that check all your assets in terms of both current and then non-current assets that has been fair valued. Put them together. Then now offset every liability the organization has. If whatever that you have fair valued according to your assets can pay off all your liabilities without stress, you can go ahead and liquidate. But then if you reconstruct and then you make profit at the end of the day, then they will ask you to go ahead and reconstruct. So they are just basically two schemes. Either you liquidate or you construct. And to liquidate is to fair value all your assets, whether current assets or non-current assets, sum them together, and then now come and then look at your liabilities. Now, it is the liabilities that will be grouping them in 7 steps. So you need to follow the very 7 steps we'll be using for that. Okay. So the scope of capital reduction scheme. Reconstruction scheme may involve the following: creation of a new shareholders of share capital of different value from the existing share, or the cancellation of existing share capital. Now, what are we trying to talk about? If there are existing preference shareholders, you can have like 10% preference shareholders. These people are taking 10% of their contribution as dividend. You can decide that, okay, let's dissolve the 10% preference shareholders and do 8% preference shareholders, or let's do 25% preference shareholders. That is the first point. You are reconstructing your capital, but then there are existing schemes like preference share or ordinary shares. You have promised ordinary shareholders that you pay them 10%. You can decide to take a 10 and change it. But for the ordinary shareholders, we don't change. Normally, it is the debenture holders and then it is the preference shareholders that normally changes. So a preference shareholder can even become an ordinary shareholder, or a debenture holder can become um, a preference shareholder or become an ordinary shareholder. That is the first point. So you can decide to allow people buy in new shares and join the company, or convert old shares. So the conversion is that you can convert from a debt, which is a debenture or a loan, to become an equity. And you know the equities are preference shares and then ordinary shares. Then you can also have an equity being converted into a debt. And then you can also have one equity to another equity, that is from one preference share to an ordinary share, or an ordinary share to a preference share. Then you can also have a debt to a debt reconstruction. So that is what they are talking about in point two. It is the conversion of a debt to equity and a debt of one type to another Then you can come down to see revaluation of assets to reflect their fair values. So there will be um, a fair value adjustment. And then you need to know that, okay, in my balance sheet, land and building is 10,000. But when I did the revaluation, land and building will be 12,000. And that is what we'll be looking at again. Those ones normally they are giving you in the question, so you don't have to bother. Now, the next one too says that writing off intangible assets, except where future value can be really established. So we'll be asked to write off some intangible asset like goodwill, patent rights. The question will tell you goodwill must be written off. So you don't need to really stress your head. So those ones, we'll look at how to write them off. To write them off means that when we are preparing our reconstructed balance sheet, they would not be present. They will not be present. Then the next one is writing off income surplus deficit. That means that every deficit. So when we start preparing the capital reduction account, and then there is a deficit in the existing financial statement, you will now have to come and debit every deficit. So the first thing, whenever you are giving your paper and then you are supposed to prepare a reconstruction, is for you to open a this one account, a capital reduction account. And then in that capital reduction account, any intangible asset that is going to be written off must be debited. Then any income surplus that must be debited, that is the deficit, must be debited. So just have this at the back of your mind. The patent right and goodwill, that the question had told you that it must be written off. These things must go to the debit side of the capital reduction account. Same way, the deficit, the one you see, the retained earning, that is in negative in the balance sheet, must be sent to the debit side of the capital reduction account. Who is calling by this time? All right, hello. Okay, so guys, let's go on. Sorry for that. Then also calling on other stakeholders to make some sacrifices where necessary. What are some of the stakeholders? The creditors, the debtors. You know, you can call your debtors to make some sacrifices, but then you can call those you owe, the banks, the creditors, the shareholders. You can call them and ask them that, oh, we owe you some amount of money, but then give them to us for free. These ones, you must also write them off to the, how do we call it, your books. So the sacrifices on shareholders, preference shareholders, debentures, and all that will go to the credit side of your capital reduction account. These are a gain to the company. So if I ask a shareholder who has maybe, or ordinary shareholders have like 10,000 and they sacrifice 2,000 for us, it becomes a gain to the company. So must go to the credit side of our capital reduction account. Now, our capital reduction account is more like an income and expense account. So anything we write off or any deficit we have, which goes to the debit side, is more like an expense, trying to reduce the profit. And the profit are the sacrifices that we are experiencing and the conventions that we are going to experience. They must take a turn on the credit side of the capital reduction account. Okay, then the next one says an additional capital injection to improve upon the liquidity situation. So people would introduce more funds in order for us to be able to keep the firm running. Now, closing down loss-making plant, delisting unprofitable product line, and introducing a potentially viable product line. So when you try to close all these things down, you take them to the credit side because it becomes revenue generated for the firm. All right. Prerequisite of a successful scheme. If you want your scheme to be successful, there are certain things you need to follow. I don't want to do more of the theory today, and so you can read on them. I've actually given you. Now, the formalities to follow in order for you to either liquidate or reconstruct. The following legal formalities must be followed in adopting a reconstruction scheme. One, you need to hold an extraordinary meeting of shareholders to approve the scheme. Two, you need the approval by a high court if your shareholders are not giving you the necessary things that you need. Then also you have to seek consent of other stakeholders like your creditors and then your long-term liability. These are people that you need to consult before you can actually reconstruct. So you don't just wake up and then you think you are a manager and then the business is not doing so much well. So you wake up and then you just close down the firm. Are we together? Yes, we are. So provision of the Companies Act 1963, Act 179. This my book is very outdated. The Companies Code provision governing capital reduction scheme are contained in section 75 to 79. Your homework, please go and look for where the provision is now, because now we are not using the 1963, but then I think we are using the 2015. So Felix, your homework for today, the first one, come and tell us where the provision can be found in the new code, but then with the old one, 79, 75 to 79. All right. So ladies and gentlemen, you can read and read and read and know the debits, credits too as well. But then for me, today, I would want us to look at to liquidate. What are some of the things that we need to know? So there are two schemes broadly that I've told you about. If I want to liquidate, there are two schemes to reconstruct, either to liquidate or to reconstruct. These are the two schemes. Now, what is the format to liquidate? Just like I said, we need to know the fair values of the asset of the firm. Now, let's do this, ladies and gentlemen. We believe that the total asset of a firm less liabilities would give us the asset, would give us the equity, sorry, right? So all we need to do now is to know the fair value of the asset and the liabilities and know if it is going to be equal to the equity or not. So you need to know the fair values of the asset, then also pick the liabilities of the question. Now, the liabilities of the question is what I've told you. Those you owe, those the firm owe. The firm, by the law, has put some preferences on them. So you don't just wake up and think that because there are creditors in the book, we have to treat that creditor first. No. Which creditor must we treat first? And which creditor must be treated second? And which creditor must we pay least attention or attention to? These are some of the things that we need to ask ourselves in liquidating. Okay. All right. So after fair valuing your assets, you put them together, and this is the total. Then you come down and write less distribution. Now, this distribution is how you might want to spend these funds. One. I have not just one. All right. So the first one is called a liability on a fixed charge or a secured liabilities. That is called landed properties. Landed properties. Okay, so let me put them here very well. Landed properties. You can write them. Landed properties. Now, what is landed properties? It is immovable asset. Asset that cannot be moved. Please, these are assets that cannot be moved. So know them. The question will tell you, bank loan secured on motor vehicle. That is not a landed property. Motor vehicle is not a landed property. So the one the question has specifically told you is on the building premises or is on the plant. You know, plants are actually installed heavy equipment because they cannot be moved. These are what we call landed or fixed charge. Two, there is something called liquidation expenses. When you read the question, it tells you that the firm actually incurred some liquidation expenses before they were able to liquidate. And that is a good cause for you to be able to subtract. And that is the second item. The first item is liabilities on a fixed charge. The next item is liquidation expenses. Okay. Now, in this liquidation expenses, the next item to treat, yes, would be preferential payables. These are taxes you owe, SNIT you owe your employees. These people, you need to pay them off. They are what we call the preferentials payable. So you need to open your eyes widely and see if there are some taxes the firm has to pay, some SNIT the firm has to pay, some employees the firm would have to pay. We call them preferential payables. Any question? Okay.
Hello.
Yes, sir.
A salary part of the like
Yes, employee
it's
salary. Now you owe
okay.
them salary. So let me put it there. Thank you very much. So employee salaries. These are what we call preferential payables. So you see, their salaries are even important more than an ordinary shareholders. That is what the law requires us to do. Okay, the fourth one says liabilities on a floating charge, not on a landed property. So just like I told you, we took a bank loan and we told the bank that you can use our car. That particular statement alone makes it a liability on a floating charge. Liability on a floating charge. Then we come down to the fifth one, the one the question is silent about. So any liability the question did not talk about is what we called an unsecured liabilities. So if it is a bank loan and the question was silent about, then it makes it an unsecured liability. Please, if you don't stop me and ask me questions, or if you don't put up a question, I would assume that we all understand whatever we are discussing, and therefore we can go ahead. Okay, so very good. So look at this question. This is a question. Question number 2, Council Limited. And then you see that they list some items. Felix, a minute, please. And then they write here current liabilities. And they write here bank overdraft secured on property, plant, and equipment. That gives you a fair idea what they are asking of you. That means that this bank overdraft must be treated first because it is on property, plant, and equipment. Then you look at a non-current liability like 25% debenture and they put in bracket unsecured. What step is it? What step number is it? It's step number what? 5. So please, the steps there, you need to memorize them all. I beg you. Okay. Felix, please come in. Felix, you put up your hand.
Yeah, I want to know the
Okay.
floating charge.
Yes.
So I would say that like any asset that is not a landed property,
It's a floating charge.
like the liability on them is a floating charge, right?
Yes, like if the company has a computer, the
Yeah,
computer is not a landed property. If the company has furniture, it is not
yeah.
seen as a land. The landed property are basically what I mentioned. The PP, you can talk about the buildings, you can talk about the lands, you can talk about the um, plants as well. Okay. Then the
Okay.
sixth one is anything regarding a preference shareholder, either the interest you need to pay the preference shareholder or whatever that you have to pay the preference shareholder must be treated as point number 6. Then after which the last one is ordinary shareholders. You now come and look at the ordinary shareholders, what you owe them and pay them off. This is all for liquidating. This is all for the liquidating. For the reconstruction, we need to draw some T accounts, and the T account will come in later. So let's look at one question or two questions under liquidation before we take the reconstruction. Okay, so the exact question I gave you to look at, the question I gave you to look at, this one, it's a past question though, but then I don't think you can see properly. All right, Abrakwa Charles, AC Limited has been trading at a loss for a number of years. The board of directors of the company is now considering the option to liquidate the company or reconstruct it. The following statement of financial position is available as at 31st December. Then they list the items: non-current assets, goodwill, development expenditure, land and building, fixtures and fittings, plant, investment. We come down to current asset as inventory, account receivable. Then we go and see less current liabilities such as bank overdrafts, trade payables, director's loan, accrued interest on debenture. Then we come down to finance by stated capital, ordinary shareholders, preference shareholders. Please, the 200, 300 you are seeing here is the number of shares. And then when you are reconstructing, we don't use the 200 and the 300. We use their values. We use their values. I'm speaking to someone who attempted it. So don't use the 300. The 300 before the word means the number of shares they sold. This particularly is the value of the shareholders. So the ordinary shareholders value is 200 and the preference shareholders value is 100,000. Now we have the income surplus. It's in brackets. So if you can strain your eyes a little bit, you can see it. It's in brackets, which means that they have been making consistent losses. We have the capital surplus to be 8,000. We have the 22% debentures to be 51,000. From this, I can see debentures are liabilities, capital surplus are equity, income surplus are also equity. So I don't need to even bother my head. Now, the additional information as a guide. Preference dividend as 5% in arrears. How do you arrive at the preference dividend? 20% preference shares. So that means 20% of the value, which is going to give you 20%. What is 20%?
20,000.
20,000. Are you sure? Okay.
Yes.
Now, 20,000, they are telling you that it's in arrears for 5 years. Meaning that at the end of the 5 years, how much are you supposed to pay for preference shares? The dividend on preference shares. Yes. How much are you supposed to pay? 100.
100,000.
Good. So don't go and ask me why we have 100,000 and I'm writing 100,000 again. The point number 2 says that the debentures are held by Adoma Bank Limited and are secured on the land building. The word is, these debentures are held by a bank. So the bank is the one that gave the debentures, and then they are telling you that that debenture has been secured on landed building. So immediately you want to distribute, the first people you need to consider is who? The debenture holders. The bank has requested that arrears of the debentures interest be paid and have intimated that they might lend the company a further 50,000. Please, I beg you, for the liquidation, the statement ends here. So both the debenture holder and the accrued interest owed to the debenture holder is a preferential, is liquidated liability on a fixed charge. Liability on a fixed charge because it is as part of the instructions for giving out the bill. It is as part of the reason why you gave out the loan. So if it is the debenture itself is on a secure property, the same way its interest is also on a secure property. Now, the statement that continues that says that they would lend you an extra money is when you have decided to reconstruct your capital. Note that the question is saying to liquidate the company or to reconstruct it. So you need to first make out what is pertaining to the liquidation and what is pertaining to the reconstruction. Okay, so having said that, this 50,000 comes in as an inflow, which would increase our cash in bank because at the end of the day, when we decide to reconstruct, we'll receive money through our banks. And then this would also go ahead to increase our capital reduction account profit. Okay, that's it. The point number 3 says that it is an additional capital injection. So they inject additional capital, 50,000. The board has demanded the overdraft to be repaid immediately. This overdraft that you are seeing here, the bank overdraft, where is it? The bank overdraft liabilities be paid immediately. They didn't put any secured or unsecured. So that should inform you that it is an unsecured debt. They didn't tell you that it was landed property or it was on a computer, nothing. It just said pay back the loan, the overdraft. It makes it an unsecured. It makes it an unsecured. Either the directors have agreed to waive their loan if they are guaranteed employment. Now, this statement should just tell you that it is when the company decides to reconstruct. When you reconstruct means that you are going to be in existence again. But so if you are liquidating, I don't need this statement. It doesn't make sense to me. If I am liquidating, I don't need to even look at it because they said guaranteed employment. Okay. The ordinary shareholders have promised to introduce additional capital of 100,000 and guaranteed the directors their job. Now, this is also when we decide to reconstruct. Liquidation is that we are stopping business. But this person is saying that, if you would give me job, then we would try and introduce new capital. That is for reconstruction. Okay. Development expenditure and goodwill to be eliminated. So we told you some intangible assets would be eliminated, and I told you to be on the debit side of the capital reduction account. The capital reduction account. So the question I told you that we need to eliminate them. Okay. The cost of reconstruction scheme is 5,000. Okay. So if you are working it, you need to work with 5,000. They will always tell you it's not supposed to be 50,000. So if I want to reconstruct, the reconstruction cost is 5,000. If I want to liquidate, the cost is 6,000. And we said that the second item to treat as part of the distribution is the liquidation expenses. And this is the liquidation expense we are talking about here. Then trade payables include tax liabilities. So this trade payables that we are seeing of 60,000 includes a tax liability of 500 and a SNIT payable of 600. This is which item number? Which item number?
Preferential treatment.
Preferential treatment. So the 500 and the 600 is for preferential treatment. The directors have decided to purchase an additional plant costing 30,000 to modernize the production system. Now, this is when the business decide to reconstruct or to continue to be in an existence. But once we decide to liquidate, then we don't need this information. Okay, the estimated breakup values in respect of liquidation and replacement cost of assets are given below. These are fair values of liquidation. These are fair value of reconstruction. So if you are reconstructing, this is what we'll be using for fair values. But then if you are liquidating, this is what we'll be using for liquidating. So they have made your job so simple that once you pick your liquidation account, the only thing that you'll be listing is land, fixtures and fittings plan, investment, inventories, and then you pick your account receivable. This you repeat the whole figures, and then you just do your total. And then you now come and do less distribution, and then you treat the ones that we have to treat. Now, it says suggest a scheme of reconstructions which will be accepted to all parties concerned. The report should include a reconstructed statement of financial position of Abrakwa Charles Limited after the reconstruction. So the first thing is to liquidate. The next is to prepare your reconstruction. And then you now prepare your financial position after the reconstruction. So after the reconstruction, we'll prepare financial position. Now, when I liquidate, I don't need any balance sheet to prove. But when I reconstruct, I will need a balance sheet. And we've not gotten to reconstruction. So the first thing is to liquidate, and that is what I expect you to do. All right. Any question before we start solving? Felix, are you checking the chat box? Richard, you don't have a
No
question?
question. No question in the chat box.
Yes.
Not yet. Please, if you have a question, put up your hand or inform our brother Felix, the catechist of the house. Okay, so beloved, let's solve this question. I wanted to write, but I'll be typing. So, what do we need first? Abrakwa Charles. You can write the first name. You know this will score you because it is his book you are working in. Abrakwa Charles. Then you neatly underline it. Please, accounting, you are not there to balance books. You are there to look for text. Okay. Then you come down and say, position of a company if it liquidates and proceeds distributed. That one is neatly underlined. Position of company if it is liquidated. I'm not saying write it in capital letters. So if it is liquidated, it is liquidated and proceeds distributed. You can write them in small letters. You don't necessarily need to put them in the capital letters, or you don't need to bold them just for clarity of work. Okay. So first, as for us to consider the revaluation figures, so it says that liquidated values, let me call it revaluation or consideration received, consideration received. Okay, so your three, your Ghana cedis. Hey, can you see?
I can.
Yes.
I wanted to share double screen, oh, but then I was just sharing one, then nobody's talking. So the considerations were the land and building. Please, I'll be using some. I wanted to write LMB, but then someone will come and ask me at the end of the day, say, what is LMB? Land and buildings. So we are doing that for 120,000. Excel would have been best, right? FNF. You know FNF?
Yes. Future and fitting.
Okay. 10,000. I'm not doing anything. No. I'm just copying for text. Plants. That is 30,000. I'm only copying what is in the question and I'll get some text. All this one, I've gotten my text already. So I'm not trailing. So those who will not go and do anything in the examination hall in accounting, thinking you need to balance your books and get it right, advise yourself. All these things gives you text. Inventories. 45,000. This is the exact question CFA's batch they had. And some people chewed the answers I gave them because I taught them. So when they went there, they were not doing anything. They were just replacing the answers with the question. But then it's unfortunate that that class was not recorded. Please, someone do the total for me. My able
Yeah, the total is 360,000.
360,000. Do you all agree?
Yes.
All right, it's 360,000. Then we come down and say less distribution. Less distribution. All right, is it difficult?
Debenture.
Hey, fellas, you're better running now. You write the first item, you write them item by item. So if I pick liability on a fixed charge before I write the debenture on that, okay? So you need to
Okay.
first write one. That is what I'm coming to because I was burdening it. Liabilities on fixed charge. Then
Into
right,
bracket, your debent
right under
secure
it,
liability.
right under it, you write your debentures. Debentures. Okay. So it was what? 51,000, if I'm not mistaken.
Yes, please, 51.
Okay. And then the next thing under the debenture was
Accrued interest
accrued
debenture.
interest on debenture. Okay. And that was what? According to our balance
4,000.
sheet.
4,000.
4,000. Okay. 4,000. Now, once you are done, this is for the first one. The second item was liquidation expenses. Liquidation expenses. Wait. Expenses. And this one was direct. So I don't need to even go ahead and write anything under it. So I can go ahead and see it's a liquidation cost.
Liquidation cost.
So liquidation cost was
6,000.
6,000. Please, I was advising myself when I was learning this that this liquidation, these expenses we are not doing it because of anything. You see, when I take 51,000 from 360,000, I can still have more to deduct the 4,000, right? That is the essence. So I'm not doing it because I want to do it, but then I'm being guided by the value I have here. This value is expected to use to offset the distribution. So once I know 51,000 from 36,000, 360,000 would give me a certain figure. Felix, what will be the difference? 309, right?
Yeah.
So I know 309,000. I can take 4,000 from it. So when I take 4,000 from 309,000, what do I have? 305, right? 305,000.
Yes. Yes.
Okay. Out of the 305,000, I can still go ahead and take my 6,000. And that would be 200 and what? 99.
299. Yeah.
All right. So I'm just being guided. I'm trying to be very careful so that I don't overspend more than what I have actually collected. It is not a must to be doing it alongside though. But then you can be doing it so that you are being guided. Okay. The question was even on the WhatsApp page in pool. Felix. Okay. After the liquidation expense, what is the next item you are supposed to treat? preferentials, right?
Yes.
The next item number
Yes.
3,
Preferential payables.
preferential payables. And here, our preferential payables were listed boldly for us. These were
Tax,
the
tax
tax
and
of how
SNIT.
much? 500.
Yes.
Okay. And then our SNIT
SNIT,
of
600.
600. Okay. 600. We can still go ahead and deduct, if I'm not mistaken. This
Yes.
should have given us 500. After taking the 500 from it, 500. And then taking the 600 from this should be 297.
2979.
7 what? 9. Did you say 9?
Yes, yes.
Okay. Now, the next item for us to focus on becomes the next item. Yes, the fourth item that I listed.
Liability
Unsecured,
unsecured.
no, floating charge, right?
Yeah.
Liabilities on floating charge. Liabilities on floating charge. And did we have any? No, we didn't have any. So we leave it and we go to the fifth one. You need to write it. It makes the examiner know what you are doing. Okay. Are we together, guys?
Yes, please.
I said, yeah, can in Yankasao.
Yes,
Sarah.
We are following.
Okay.
Shatta say you get a question to ask.
Shatter. Where is he?
Mm. He
Unmute
raised
him.
his
Unmute him. Unmute him. You can actually unmute him. Unmute
Shatta,
him.
I can't see you, Shatta.
Shatter, put up your hands in the reaction. Shatter, I'm asking you to unmute. Unmute and ask your question, please. Okay.
So, Bernard, with the steps, no,
Mhm. Oh, is he lost again?
No, he's asking that whether the step you don't have to mix them.
No, you don't mix them, please. I beg you. It is chronological. It is exactly what the law is requiring us. So you can't mix any. Once you mix it, you have zero. So these are the
okay.
steps. You see, if you watch some YouTube videos and then if you decide to read some textbooks, they are giving you some different steps. I beg you, these are the right steps. Even K will tell you. No, he didn't even teach us. He made some doctor from somewhere came come teach this course, and then we're just laughing because some of us had already gone through the questions and then some of the things that we need to know according to the current laws, and realized that she was just doing something different according to their old ways. But then this is the best way to go about it. We couldn't just laugh. We couldn't just query her because she has this abodin crater. Okay, so the next one is unsecured. Unsecured debts. And then the unsecured debts, according to our question, the first, we'll go and look at all our inventories. Which one haven't we treated? Yes.
Is that
Yes, let's look at our liabilities. Which ones haven't we touched on? These are all part of what we
over the over?
Overdraft.
overdraft, bank overdraft. So please open your eyes, bank overdraft. That is how much?
15,000 or
20,000.
20,000.
All right.
So
Hey, please, what will be left? Be guided, oh. Once we
trade
are
trade payable.
trade payables. Okay. What will be our trade payables? Let me see if Felix can get this one correct.
Trade payable it will be 58,900. That's
A very smart guy. Okay, so guys, you see this trade payables figure we had there was 60,000. Out of it, we were told there is tax of 500, and out of it, we were told there's a net of 600. So you need to deduct them from it. So please, that is how come we had a 58,900. Where is the question? Read it very carefully. It says that point number VII, trade payables include tax. And then now that we have recognized the tax and the SNED, it means that the remaining is for trade payables. Are we confusing some people? Okay, so 20,000 from this should have given me 27,700 and 27,700 and 7,900. And then if you take this one from it, there will be a balance of about 277,900 minus 58,900. 21,900, right? 21,900. 21,900. I'm just trying to say we are being guided. If because I've solved the question before, I would have gone straight. Okay. Do you have any other? We have directors loans, right?
Director's loan, yeah.
15,000. It is also part of it. Okay. Directors loans. Okay. So when I take 15,000 from this, I should have
204.
20,400. Are there other ones we need to treat? So
Yes,
once we get
please.
to this stage, we sum everything here up. Before we treat stage 6 and stage 7, everything we've done for stage 1 to 5 must be summed up, and then we now have to cross-check and know the difference. Okay, so that is why I was doing it. So we should have 204,000 to spend. So let us see if it is true that if truly we have 204 to spend on the preferential preference shareholders and then the other people. Please, what's the total for?
156,000.
When you do the entire total,
Yes.
wow, 156 per. Okay, 156,000. Now, if you take that from the 360,000 is what we have.
204,000.
Thank you. Much appreciated. 204,000. Okay, now this we can go ahead and do step 6. You see here, in some questions, the money will most often get finished up before you even get finished up here. What you have will be less to share for your secured debtors or unsecured debts. So what you do is that you prorate. You do a prorate for these places. Once we pick a question like that, I'll show you. You don't even have some to pay your preference holders, shareholders, and then your ordinary shareholders. But then it's quite fortunate that this question had given us the go-ahead to pay them. Now, we come to preference shareholders. Preference shareholders. Okay. Now, right under the preference shareholders, we already owe them their value. Their value, preference shares were preference shares. I told Felix that. Yes. Felix, what is preference shares?
The value of the preference shares.
Yes.
It will be 20% of the 100 CDs times 5.
The guy is still lost. Okay, anyways, I'll consider him. The value is 100,000. and then their dividend is what he's mentioning. Their dividend is what he's mentioning. Oh, I don't have space. So their dividend is what he's mentioning as, so right under it, I'm looking for space to write this thing. Oh, I have space here. I've confiscated all the spaces. So bear with me. So after the preference shares, you just put in the preference dividend. You see, we had some dividend to pay them. And then we said the dividend is the 20% of how much we're supposed to receive on how much we're supposed to receive for 5 years. 5 years. And that is also going to give you another 100,000.
Oh, is that so?
Yeah. You need to first pay them their value, pay off their values before you come and pay them any dividend that is attributable to them. Are you okay?
Yes, please.
All right. So now, what is the total?
It will be left with.
The total will be 200,000, if I'm not mistaken.
Yes, it's 200.
200,000. When I take the 200,000 from 204,000, what do I have left?
4,000.
4,000. Now, that's what the shareholders are coming to share. Now, how much is the value of the shareholders? The value of the shareholders is 200,000. Now, they have just 4,000 to share. We can't say, then let's pay some people their 4,000 and then let's keep the rest in outstanding. What you need to do is that you need to find how much each person is supposed to take. Now, you can see that there are 200,000 shares here, and then the value is 200,000, meaning that every share was sold for what? 1 cedi. Guys, a minute, please.
Kill.
All right, so sorry, I'm back. Let's continue. So we can see that the amount per share is going to be the 200 divided by 200. So for every shareholder paid 1 cedi for 1 share, right? Then the question is that if every shareholder is paying 1 cedi for 1 share, what amount can we give every shareholder? So to know how much to give every shareholder, here, we don't even know it. You are stuck here. So you just write amount available to shareholders, amount or available amount
To ordinary
to
shareholders.
ordinary shareholders or the shareholders. Okay, we started with 9's population, but I said, yes, yeah, sound. Okay. Omokoda. All right, so this is the amount you need to share. Now, don't forget that these shareholders, they had contributed, so shareholders, ordinary shareholders, sorry, will be equal to the 4,000 left for them to share divided by we'll multiply it by 1 cedi per share. 1 cedi per share. Then we'll divide it by
200,000.
what's it say? 200,000. So that we'll know how much each 1 cedi per share would receive as part of what we want to give them. So what is the value? I think 0.32, if I'm not mistaken. Let's do it for me. Do it for me.
0.02.
0.02. All right. So that means that every shareholder that you know will receive
Then 2 pesos.
yes, will be receiving 2 pesos for every 1 cedi. 0.02 for every 1 cedi share contributed. Every 1 cedi share contributed. Are we together? So this is it. We are done. So you are telling them that, yes, we can pay everybody. But when it gets to the shareholders, every shareholder who has contributed would have to sacrifice almost 0.98 and then receive some 0.02. For that one, it is not much of a problem because it is the shareholder who. So if the company should liquidate, all shareholders, all stakeholders will be fully paid except ordinary shareholders who would receive 0.02 of their value. Is that clear? So that is about it.
Bernard,
Yes, madam.
please, there is a chat in the box.
Please, can you take it again? If you are done, just a quick one. I lost track due to network. Okay, so what we said is that after paying everybody, when we get to the preference shares, we'll still be marking time. Okay, so we realized that preference shares, they contributed 100,000. And then they had some interest in arrears or dividend in arrears to be paid them. So we would also pay that one. Once we pay that one, we'll be left with 4,000 to give an ordinary shareholder. And then this ordinary shareholders, they have 200,000 shares. And then we have 200,000 in value. So the shares were 200,000 and the value was 200. That means that every shareholder paid 1 cedi. So we don't care if it is just one person who bought 5,000, one person bought 10,000 or not. All we know is that every shareholder has paid 1 cedi for every share. Therefore, we have just 4,000 to share for these 200,000 people. So what do we need to do? We need to divide the value of the 4,000 left by the number of shares available. Number of shares available, multiply by 1 cedi per share, and we realize that every shareholder is going to be paid 0.02 for every 1 cedi share contributed. So in summary, if the company liquidates, if the company should liquidate, all the stakeholders, you know who the stakeholders were, right from the preferential treatment through to the government, through to the liquidation expenses downwards, they are all stakeholders, would be fully paid, except ordinary shareholders who will receive Ghana cedis 0.02 for every 1 cedi contributed. Thank you. We are done. So that is all about liquidation. Shut are you okay now? So I'm opening everybody. You can ask your questions. Will be anybody can ask question before we take another thing to do. So okay.
Ben,
Yes, sir.
I mean the whole thing.
You said
The whole thing, that's what I meant.
I should repeat the whole thing.
Yeah.
Shut up. Dear bundle.
Yeah, bundle.
Say bars, my nigga.
Bars.
Shut up, bundle. Shut up, do you have bundle?
Bars, my nigga.
That is shut up, bundle. So basically, what we're referring to is that you see a company can be going through some challenges and that they would have to either reconstruct their capital or liquidate. Now, to reconstruct means that there'll be some changes in their capital movement. That is, there'll be an introduction, there'll be an injection, there'll be conversion of one form of ordinary shares to another. These are all part of the things you should know. But then with this particular question, we are either to liquidate or to reconstruct. And then because I've only explained liquidation to you, we are trying to focus on just liquidation. So anything that we read from the question, that is as part of just liquidating is what we're going to take. Now, the first thing we're going to take is your consideration you're going to receive. That is the fair values of the assets that you are going to liquidate. So once you want to liquidate, it is expected of you to fair value your assets. So that the question will provide them. So you just have to go in the question and select all of the fair value items. So we didn't do anything, but then we just listed everything here and then we did the total. Now, out of the total, you need to pay off some expenses that you might have incurred or some liabilities that you are owing. Now, these liabilities are chronologically arranged. It starts from liabilities with fixed charge. It moves to the next one that says liquidation expenses. It talks about preferential payables. It speaks about liability on floating charge, unsecured liabilities, preference shareholders, and ordinary shareholders. You need to list them in the examination hall. So when I pick liabilities on a fixed charge, I'll go to the question and ask myself, which part of the question stated that this liability that we had taken or this liability that we have is on a landed property. And then point number 2 concerning debentures is talking about debenture on a landed property, which is landed building. That means that anything pertaining debenture was secured against a landed property. So it's accrued interest and then the debenture itself was on a landed property. So we first write it out and then look out for if there are more. If they are not, we go to the second item on the list, which happens to do with liquidation expenses. Now, that liquidation expenses is the cost you incurred when you wanted to shut down, and it is at point VI, which says that the cost of reconstruction scheme is 50,000, which I said we change to 5,000. And then while the liquidation cost is estimated at 6,000, so meaning that there was a liquidation expense of 6,000. Then the next step, which is step 3, speaks or talks about preferential payables, such as the debt the company owes the government institution or the debt the company owes its employees. These are the two things under preferential treatment payables that company must honor. So going through the list, we realize that they owe taxes and then they owe SNET. Point number VII. It says in the trade payables include a tax liability of about 500 Ghana cedis and then SNET of 600 cedis. These are considered as preferential treatment. So even the government would come when I've paid secured or let me put it secured debt that I owe and then my liquidation expense before I begin to think about the government that I owe and then the employees that I have to pay. Having said that, the next item is liabilities on a floating charge. Any liabilities that was secured against a movable item. According to our question, we didn't have any, but then we still write it out so that the examiner will know what we have, right? So we can write it down and then put a dash there. Now, I'm saying that that's the thing that you are doing. Once you are doing them, when you pick the figures, be checking the figures against what you have as your fair valued asset to know that you have more to still settle your debts. So we were doing it alongside with what we have, and we realized that yes, it can still be taken out of the amount of our fair value. Then we come to our unsecured debt. The unsecured debt are any other liabilities that were not on a fixed or floating charge or were not preferential payables or were not liquidation expenses. And we had bank overdraft, trade payables, and directors loan. Now, in our trade payables, because in our footnote, vein I says that there were some taxes and SNITs included, and then we've already paid the taxes and SNITs. That means that our trade payables value would reduce to 58,900. Okay, having reduced them and paid your director's loan, I said that before you go to point number 6, which is the preference shareholders, sum from point number 1 to point number 5 up. Know the total, take it from your fair value asset and know what is left. And ask yourself, can you go ahead and pay your preference shareholders and anything accrued to them? Yes, we had some dividend accrued to them in 5 years. And these debenture holders will take 20% of whatever value they contributed, and would also have to take what we call the number of years that the thing is accrued to them. And that is what gave us 100,000 and 100,000. Taking my 100,000 plus my 100,000 is 200,000. From whatever figure that is left, I have 4,000 outstanding. Now, ordinary shareholders contributed 200,000 value. Meanwhile, you only have 4,000 for them. What do? You only have 4,000 for them. So what do? You need to find that 4,000 over the number of shares multiplied by amount per share so that you can tell us that, okay, so for every 1 cedi for every amount of shares contributed, the person would receive this for that particular amount. And that is all we have done. Shatter, I have gone over for you. Are you okay?
Yeah, thank you.
You're welcome, sir. Anyways, so that is it for liquidation expenses. So I don't know if I should leave you with one question and you solve it for us. Then in our next class, we'll take the reconstruction, or I can take the reconstruction, and then we would wait and solve a question in the previous class. Okay, so you can try your answer on this question. I don't know if it's on the paid page or something. So it's
There's a
about
question on the chat group.
okay. Please, if it is a floating charge, will it be stated clearly? Yes, boss. If it is a floating charge, they'll tell you. Something you see here, we have unsecured. You see the debenture in this question was secured, but here it is clearly stated unsecured. So it must be treated under unsecured. Now here, bank overdraft rather is secured on a property, plant, and equipment. Don't forget, there can be any other asset. So if it is unsecured, the question will tell you that it is on motor vehicle. And brothers and sisters, it is not a landed property. Even if it is on inventory, inventory is not a landed property, so you should know. Okay. Now, also be careful. Also be very careful. Reasons being that if it is a secured debenture, it means that it is going to be matched against that particular item they secured against. So you see, which one is this? Debenture is 51,000. It was secured on your land, right? Let me be a bit clear here. This 51,000 plus the 4,000 is going to give you 5,000. It was secured on land and buildings. True or false?
True.
Okay. Now, if it was secured on land and building, what is the value for land and building? 120,000. So you can still go ahead and pay the entire amount. But there are cases whereby it is going to be more than what it was secured against. What you need to do is that you treat the exact amount on the item and then go and treat the excess as an unsecured debt. Am I communicating something to someone? Here, we were fortunate that the two is 55,000 and the landed property was revalued to 120,000. Therefore, I can take 55,000 from the landed property, right? Now, there are instances whereby it is going to be matched against a landed property. And then assuming the landed property was, say, 4,000. And then the secured debenture was, say, 5,000. What you need to do is that under the fixed charge, go and treat the entire 4,000. And then find the difference of the 1,000 and treat that difference of the 1,000 as part of an unsecured debt. Are we together?
Yeah.
Good. So you need to also open your eyes. This question, because it was 55,000 less the fixed amount, that is why I didn't bother to explain. But because people are raising concern, it is deemed fit for me to tell you that here is 5,000. Agreed. The landed property was fair valued at 4,000. You are owing 5,000. You have valued your item at 4,000. Who are you expecting to pay the 1,000? It's supposed to be charged against your unsecured debt because you didn't use what you secured against, you have fair value it lesser. So go and pay the entire 4,000 agreed, but then leave the rest 1,000 to something else. Ese Gomalu.
Barankwe.
Apesia. Ma when you now get it.
Banama.
So, Madania Igbeni. Hey. So this question can be solved by you and by me. Okay. But then I want you to try your hands on it. And then in our next class, we'll do it. So here it says, in the event of the foreseed sale, the asset would probably raise the following amount. So these are the fair value assets. One, plant and PPE 1,500 million, inventories 400 million, accounts receivable 450. So look at it. The assets were PPE, inventories, and accounts receivable, meaning that something will happen to the patent right. It is either going to be cancelled out or not. So that will be the question's discretion. So the company is developing a new product which is expected to generate profit before interest and tax of 500 million per annum in the anticipation of an immediate capital injection of 200,000. Now this is for reconstruction. This is for reconstruction. This is for reconstruction. The next point says that the ordinary shareholders should be written off too. This is also for reconstruction purposes. 20% of the shareholders are to convert into 500 million ordinary share value. That is also for reconstruction purposes. And then the next one too says that it is proposed that 650 million of the 25% are to be converted into ordinary share at 1 cedi per share.
Reconstruction.
Reconstruction. Accounts payable to accept immediate payment of 50% and moratorium of 6 months in payment of the remaining balance. New supplies this is also for reconstruction purposes. A 2-for-1 rights issue will be made this is for reconstruction. Property, plant, and equipment are to be revalued. Okay, so this is for your reconstruction, and this is for liquidation. Property, plant, and equipment are to be revalued at 500 million, inventories at 800, and this one at 450. So that's for your liquidation. And look at the liquidation expenses. Liquidation expenses will amount to 10 million. So you don't even have much of a job to do under liquidation. All you need to pick is that I pick my revalued asset here. This ones, I write them and I put down the total. Then I'll check if we have some secured and unsecured. Luckily for us, the first fixed charge we have is bank overdraft. Bank overdraft secured on property, plant, and equipment, 750. And then we have the next item, which is a liquidation expense of 10. When I pick the liquidation of 10, do we have any other item again to treat? Do we have any other item again to treat? So we can treat your accounts payables, and then you can treat your no, you can treat your debenture too as well, and then you treat your accounts payables, and whatever that is left, you try and see if you can pay your preference shares, and then you can pay your ordinary shares. So we'll come and solve it, because when we get to the unsecured, you realize that the money will finish. So you can be doing it along. You realize that the money will finish under the unsecured. Let's see if we can do it briefly, because I know students will not go and solve it, and they will come and tell me some stories. And so let's pick it. Is it Kanzo? Kanzo Limited. Kanzo. Aye. Okay. So I'm going to copy the exact statement here. My brain team, mean type, a position of the company if it's liquidated and had been distributed. Okay. Okay. All right. So revalued item. Revalued. I put my currency signs. Okay. So the first item was PP. PP. What is the value? So you can keep the million up there, sorry. So let's put some millions here. Okay. So this means million. That means million. All right. So PP was 2250. And then we have inventories. Inventories of 800. We have accounts receivable, receivables of about 450. What is our total, please? Total?
$2,500.
Thank you. Okay, so if that is it, less distribution. Less distribution. Please, if you are seeing stars, call me. Bank overdraft. Am I running to? It says we should go chronologically. But we said liquidate liabilities with fixed charge, or liabilities on fixed charge. What's the statement that I put up there? Liabilities on fixed charge. On fixed charge. And I'm in timber for some. T. What we put there is bank overdrafts. So, yeah, for you. What do you have for bank overdraft? BOD. So you. Okay. The next one is what? Liquidation expense. Liquidation. Hey, is it correct? Is it correct, Mecca? That is 10. It was 10 million, right? The bottom part of the question, this one. Okay. The third one was preferential treatment, preferential payables. We didn't have any, do we? No. Then the next one was don't confuse yourself with this one. The tax rate is 25%. You can't pay taxes on losses. You didn't make profit. Look at it here. I know students will be asking. Retained earning here was 750. So the tax here is just to confuse you. So don't go and say there's a tax here, so I'm going to put the tax under preferential payables. No, you can't pay 25% on losses, except otherwise they have told you the tax is in the question. So here, profit before interest and tax. So this one is for reconstruction. That is it. So don't bring the tax here in this particular one. Okay, so the next item is what? What am I thinking of? Point number 4, floating charge. Liabilities of floating charge. Do we have any? We don't have any. Guys, a minute. Let me check my solution. I think I have a solution. I look forward. I treated the payables, the tax in the question, so refute. Remember. Okay, sure, sure. Sorry, I used the wrong figures here. That one is for when I'm reconstructing. So this is the exact figures. Because I was seeing a difference. The difference is too huge. I was even scared. So this is for the reconstruction, the liquidation, and that is for the reconstruction. So please give me the total again. 1500 plus 400 plus 450. That is 2350. So the revalued amount, I picked that of the reconstruction, leaving ours out. So, because I realized that when I get to the unsecured debt, I need to find a difference. Unsecured debt. See, the unsecured debt were payables of 1,000 and then debentures of 1,000. But then look at it, 750 plus 10 from 200 and 2,350. What is the value? What is the value?
$1,590.
Are you sure? 2350 minus,
Minus 750.
and that is what? 1590.
90.
Now,
1590.
unsecured debentures are taking 1,000. Accounts payables, which are unsecured, are taking 1,000. Who are you going to give, and then who are you going to leave out? Who are you going to give, and who are you going to leave out? Because there are no merits for arranging them. Okay, so here we'll prorate the figures. We'll prorate the figures. Give me this one again. So we find the sum. 1 plus 1 would have given us 2. This is taking 1,000. So it will be the 1,000 divided by 2,000 multiplied by the amount that you said is left. What was the amount left again? 1,590. Right. Then you do the same thing for account payables. He is also going to take 1,000 divided by the 2,000 multiplied by the same figure of 1,590. Here, because we cannot pay them everything, we can't choose who you have to pay or honor first before who you don't have to honor. So because they are all unsecured, you need to find the difference and then share it evenly for them. So this will give you
Hello,
some.
Bernard.
Yes, madam.
Kindly take that part again, please.
I will video no more. And I'm a and actually video mention. All right, so I was just saying that once you are going, you are being mindful. All right. When I did my overdraft and my liquidation expense, there were no preferential payables. There were no liabilities on floating charge. When I got to the unsecured debt, I realized that debentures is 1,000. Now, because they didn't put anything before accounts payable doesn't make it unsecured. It is also unsecured because it is a liability. The focus is to pay off all your liabilities. So I just mentioned that any liability that is not as part of 1, 2, 3, 4 must be captured under 5. Are we together? So since account payable was silenced, doesn't mean that account payable is not, but an account payable is also part of the unsecured. Now, the value for each of them is 1,000, 1,000. What is left after you take 760 from this figure? I'll be left with 1,590. Who do I give his full amount and who do I leave his own? They will both not agree. So what you need to do is that you find the addition of the amount that is supposed to be paid to the two of them. If they were 5, you would have added all the 5 and picked the value you have to pay that person over the total you have found for all the unsecured people and multiply by the figure left to be distributed. So the figure left will be 1,590. Fortunately or unfortunately, this was 1,000, this was 1,000. So the total will be 2,000. If I want to pay this person, is his value over the total between the two of them, which is 2,000, multiplied by what is outstanding for us to share. That is 2,350 minus 750 minus 10. That is 1,590. And that is going to give you 795. Same for accounts payable, 795. When you sum them up, you sum this one, you realize that it is a 0. So your report can be that the preference shareholders and then the ordinary shareholders, they will not receive anything. They would have to forfeit it. And then even with that, your debenture holder and then your accounts payable will still have to top up by how much before you can fully pay them. What is 1,000 minus 795? You still need 205 to top up for your debenture holder and then your accounts payable holder before you can settle them in full. So if I've not settled these people in full, I can't go ahead and pay my preference shareholders and I can't go ahead and pay my ordinary shareholders. Are we in the spirit?
Yes, thank you.
Then Bernard,
Yes, sir.
I think knowing what elements constitute the unsecured debt will help in this regard. If
Yes.
you don't know, because
So
if I were the one solving this thing without knowing, hearing this part from you, I would have thought that the venture when we are, is way long-term liability and then way
it must be
it
treated
would
as a fixture. So that is what I'm saying, that the question will give you a guide. You see, it has written here unsecured. Okay, so the unsecured is basically anything that is not on a fixed charge not as a liquidation expense, preferential payables, floating charge. The floating charge, I've told you, they'll tell you on your computer, on your desk. That one, because the asset is movable, that is why it is called a floating charge. Now, after, the next is unsecured debts. Now, all your liabilities that have not been captured in any of the above mentioned must be treated as unsecured debt. So before you pay those ones, make sure you know your balance. You can't treat any of those under the unsecured with much priority. No, they are all equal. So even if the money gets to preferential payable, and then what I have is less, what I have left is less to share. Even the government, I can't say because I owe SNIT 600 and I owe tax 500, so I would need to give SNIT 600 and give tax. Maybe I have just 400 left. And then I'll say, okay, because SNIT is important than tax, I'll pay the 400 to SNIT. No, you need to find the total of the SNIT and the tax and share the 400 CDs for them. So it's just like sharing the money that is left for the people. How do you do it? Do you get it? How do you do it?
Yes, boss.
Okay, so having said all of these, and then having been able to go through,
So as JFK asked earlier, the floating charge, they will not bring floating charge, but then they will say like unsecured, right?
they can tell you floating charge. It depends on what the question is bringing. The question can hit you and tell you this is a floating charge. The question can also hit you and tell you that this is on computers, this is on television of the company. I don't know if you get what I'm trying to say.
Okay.
Yes. So, see if I have one. So the bank holds a fixed charge on property, plant, and equipment as security for the overdraft. So you see this question too, the bank overdraft here. The point number 2 is telling you that it is a fixed charge. So you see, the debenture is secured by a floating charge over the assets of Bunkun Limited. You see, it has told you this is a floating charge. See? So you know where to treat your debentures when you are liquidating. The first part from here to here is for capital reconstruction scheme. So you see, it says if the capital reconstruction scheme is accepted, points here, the debenture is secured by a floating charge over the assets other than the freehold property. So I don't know if there's a freehold property in this question, but then all I can see is that floating charge, these are the items they have revalued. So there will be no floating charge specifically. So once you are done, you treat it at a floating charge. And it is a debenture. So where is the debenture? The debenture is 300,000. So you need to go and treat a whole of 300,000 and that floating charge. Is there any question? Let me see. Were preferential creditors. So you see, 50 million of the trade and other payables of 140 million were preferential creditors. So these are also part of the preferential payables. The question I told you, so they are preferential payables, creditors. Creditors are people that you need to pay. So they are, what's your trade payables? This is 280,000. Check 140 plus 50. We'll give you 190. So if 190 out of 280 are preferential, it means the extra of about 90,000 is going to be treated as unsecured. I don't know if you get what I'm trying to say, Felix. Felix and group.
Yes, please.
So if you read this question, it should guide you. Pa, 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 pa.
Single queen.
Talk to me nicely if you want to talk to me.
Question.
So no question. I've been waiting for like 30 years for questions. Nobody's asking questions. So
Okay. Bernard,
yes, madam.
please. So, those who were not able to receive anything, what happened? Please, almost a kind of and I say,
Ashe. Sikanashi.
hey,
And so you can't blame them. All you can do is that you take them to court. And then finally, if it is a limited liability company, you are limited to their shares. But then if it is not a limited liability company and it is unlimited, you can now fall on the shares or the properties of the shareholders to settle those debts. Do you get it? So they themselves, they'll lose what they have contributed. They'll lose what they have contributed, plus they'll fall on their personal belongings to be able to sort out the remaining debt that is outstanding. Hey, I'm viewing another question. Okay, so they would lose their it's 2,000 million, 2,000 million, and then at the end of the day, sacrifice to go and pay with their own personal belongings, the surplus to top up for venture holders, account payables, and then the preference shareholders. And then they'll lose their everything. If it is an unlimited liability company. Oh, who asked a question? I want to let you know. Maybe some question. I want to let you. All right. So, anyways, that is it. But then for your other course, back on the preference, reconstruction, there. Can we start that? Normal bread.
yeah, let's start.
Let me give an intro so that we can get rest.
Okay.
So capital reconstruction, they are basically
Bernard, Bernard,
yes, please.
I think say a person share we move na as a yati ase no ye hu so
Okay,
that
Lepacho Yomate. Thank you. So capital reconstruction, there are three accounts that you need to open. One, a capital reduction account, and two, bank or cash account. Three, ordinary shareholders account. Okay, I'm just leaving you here. Shareholders account. I'm not taking it far. Note that these are the three major accounts you'd have to open. For that, you can't take an options to it. The other account that you'll be opening will be just debit, credit, debit, credit, debit, credit. So if I debit one account, I'd have to come and credit one account in any of these three. So that's one to look at it. And so please, that is all that I also want to leave with. Thank you all for joining. And the next class there, as Felix said, kill and yeah.
but